we embark on yet another journey through the largely profitable, sometimes turbulent, but never dull world of investing, it is always wise to pause, reflect, and ask ourselves, what's changed? What's new? Much as an old sea captain would read their sextant periodically, celestially navigating through using the sun, moon, or stars to gauge their latitude and longitude, we too regularly check our position when new information comes our way to maintain the right course. In Insigneo's Investors Almanac for 2024, we will provide an in-depth analysis of global economic trends and forecasts for various markets. A key theme is that though the investable seas are clear today, murkier waters lie ahead as monetary headwinds, geopolitical risks, and high asset valuations cloud our passage in the second half of the year. We discuss trends in various sectors, including equities, rates, credit, currencies, commodities, and emerging markets, highlighting the impact of geopolitical considerations, fiscal policies, and consumer behavior in these sectors. The first half of the year's optimism will gradually give way to caution as we navigate complex markets and prepare for potential economic softening in 2024. By many measures, this remains the most complicated investment landscape of our lifetime. To be sure, there are safe passages out there brimming with opportunities, but we must tread carefully and skillfully as tempestuous waters lie all around us. Is the consensus wrong again? Last year was not a good year for professional forecasters. Annual outlooks for 2023 were laden with predictions for recessions in the United States and most other major economic blocs around the world, coupled with bearish expectations for many financial assets. In fact, for the first time in the history of the data, Wall Street consensus expectations, as compiled by Bloomberg, were that the S&P 500 would end the year deeply negative. Well, we are glad that we took the contrarian position. Not only were we not forecasting a recession, but we also expected a positive year for the broad index. But even our own optimistic projections fell short of the market's exuberance. We expected the S&P 500 to return between 8 and 13% last year, well above the consensus. Well, it soared more than 26%, driven largely by an astonishing 1,800 basis points of multiple expansion as rate expectations fell particularly sharply in the final quarter. To be sure, most of the gains were concentrated in a few AI-related names, such as Nvidia and Meta, which led to a massive dispersion of returns between the broad index and the median stock. Consequently, only 32% of active managers beat their respective benchmarks last year, again a historic level of underperformance never witnessed before. It turns out that the wholesome combination of excess U.S. consumer savings and a strong labor market were strong enough to keep recessionary forces in check. Well, this year market expectations are pointing in the opposite direction. Everyone is expecting a soft landing of the U.S. economy, and financial assets are already discounting this outcome. Predictably, consensus estimates have regained their positive bias, and most major Wall Street firms expect the S&P 500 to end the year above 5,000 for the first time in its history. Most recessionary forecasts have gone the way of the dodo bird. Given this set of above-mentioned facts, does it make sense now to adopt the contrarian position once again, to predict the recession and reduce risk in our portfolios? The Macroeconomic Outlook. The American labor market remains the steadfast pillar upon which much of this newfound optimism stands. It remains incredibly robust. To understand why, it is important to expand on a concept well known to most economists, the Phillips curve. It is a framework that depicts an inverse relationship between the rate of unemployment and the rate of inflation within an economy. Developed by economist A.W. Phillips in 1958, it suggests that with economic growth comes inflation, which in turn leads to more jobs and less unemployment. This relationship was initially based on empirical observations, showing that inflation tended to rise when unemployment was low and vice versa. In the short run, the Phillips curve appears to hold due to the immediate impacts on inflation and employment. However, eventually this relationship might not hold true as other factors influence inflation. Indeed, some economists like Milton Friedman have changed the original Phillips curve, proposing that it only works in the short term because inflation expectations adjust over time. As workers and firms adjust their expectations of inflation, the trade-off between inflation and unemployment disappears eventually, especially during periods of stagflation, where high inflation and high unemployment occur simultaneously. The model faced some pushback, leading to the development of the expectations-augmented version that provides a more nuanced view. It suggests that any inflation-unemployment trade-off is temporary and influenced by people's expectations. In sum, its usefulness depends on the specific economic context and period being considered. In the short term, it can sometimes help predict the trade-off between inflation and unemployment. Eventually, it is less useful. A further refinement of the Phillips curve framework accounts for nonlinearity. In other words, it means that the trade-off between inflation and unemployment might not be constant across different levels of unemployment. For example, the impact on inflation might be different when moving from 5 to 4% unemployment compared to when moving from 10 to 9% unemployment. The concept is straightforward. When labor market slack exists, employers do not need to increase wages significantly, keeping inflation in check. However, in a full employment scenario, firms compete for labor by offering higher wages, steepening the labor supply curve. This non-linearity could be interpreted as a kink in the curve. It might also imply that there are certain thresholds or points of unemployment at which the behavior of inflation changes more dramatically. For example, when the unemployment rate drops below a certain level, like the natural rate of unemployment, the inflation rate might increase at a faster pace. Indeed, this model has effectively explained recent economic trends in the United States across 4 distinct phases since the pandemic began in 2020. The pandemic's onset marked the first phase, drastically increasing unemployment as businesses scaled back. The second phase saw government and central bank interventions stabilizing labor demand, with inflation remaining low due to the economy not reaching full employment. The third phase witnessed an overheating economy, with a spike in wage growth and inflation. The fourth phase involved Federal Reserve interventions, leading to a surprising stability in employment despite slowing wage growth and decreasing job openings. The pandemic also altered demand composition, with a shift from services to goods and back, impacting inflation and output in unexpected ways. Supply-side factors such as reduced labor force participation and subsequent expansion played significant roles in these dynamics as well. Contrary to recent history, the next recession may simply result from ongoing monetary policy tightening. The economy could transition from growth to recession once job openings decline significantly, a shift that might catch some investors off guard. We may be approaching that point sooner than many now think. As Chart 1 demonstrates, during the post-pandemic peak, the U.S. job workers gap, i.e. the number of job openings per unemployed worker, reached a zenith of almost 4 in 2022. Since then, the trend has clearly fallen and probably sits close to 1.5 currently. If they continue to drift lower at their current pace, we expect it to reach 0 by the middle of this year. This would mark a phased transition in the U.S. economy, one going from labor deficits to labor surpluses. As this chart suggests, this transition is highly correlated with the onset of recession because workers who lose their jobs would find it hard to find new employment. This U.S. labor market framework fits neatly our own Insigneo forefront recessionary probit model. Currently, it is reflecting only a 3% chance of a U.S. recession over the next 6 months, not a major concern and one that argues for risk-seeking over that same time period. Over a 12-month period, however, those odds increased to 52%, suggesting concern as we approach the summer months, but still far from elevated cautionary levels. The Fed believes that it will be able to bring inflation back near the Fed's target by the middle of 2024 while avoiding a recession altogether. The implication is that the Fed does not need to raise interest rates any more than it already has. While we are sympathetic to the view that the Fed could temporarily achieve a soft landing, we are skeptical that it could stick that landing for exceedingly long. The reason is that once an economy achieves full employment, anything that pushes growth above trend could stoke inflation, while anything that pushes growth below trend could lead to rising unemployment. Once unemployment starts rising, it usually keeps rising due to positive feedback loops. Falling employment tends to feed on itself as workers, both laid off ones and the rest who are fearful of being laid off, will cut back spending as they get fearful. The Fed's dovish pivot in December of 2023 does, however, give us some optimism that it may be able to stick that elusive soft landing, although it will require a degree of fine-tuning never before seen. Putting our recessionary probit model together with decision trees that account for things like policy calibration and/or mistakes and positive negative exogenous shocks to the system, we arrive at our overall subjective recessionary probabilities framework. Over the next 6 months, we place the odds of no recession at 85%, of a mild recession at just 10%, and a severe recession even lower at just 5%. Over a 12-month window, the probability of a mild recession goes up to 45%, a no recession scenario falls to 45%, and a severe recession goes up slightly to 10%. For clarification, a mild recession in our framework is one where the unemployment rate rises above 4% but remains below 6%. So why would we expect a mild to moderate recession in the first place? Well, the U.S. housing market, characterized by a low homeowner vacancy rate and healthier mortgage debt levels, is poised to positively respond to Federal Reserve rate cuts. Additionally, the absence of excess capital expenditure and the normalization of manufacturing inventories are favorable signs. Corporate and consumer balance sheet health appears generally stable, and the large U.S. banks are in great shape going in. In other words, we do not see material imbalances in the economy that would worsen or lengthen any downturn. Because our recession-no recession probabilities are so evenly matched, we will provide market guidance in the following section that reflects this dichotomy. A final word on inflation. Many real-time indicators we follow, particularly those tied to asking rents, point toward a sharp drop in shelter inflation. Core goods inflation has been negative since June and should remain subdued. Finally, slower wage growth, the single most important driver of services inflation, is highly likely to continue falling as the trend in job openings, the quits rate, the hiring rate, wage surveys, and other survey data all point to a weakening jobs market. So further disinflation should be the expectation. However, while we expect inflation to continue falling, the risks of a resurgence remain and cannot be completely ruled out. While headline inflation is forecasted to decrease in the coming year, a change in inflationary mindset is expected to keep the global core inflation rate around 3%. Adaptive expectations matter, and we should monitor long-term inflation expectations carefully for their signaling value. For now, though, the benign price trend remains in place. This table highlights our summary forecast for the most important global economic blocks. These figures suggest that we anticipate a slowdown in global growth, falling below potential levels across the board. This trend is attributed to the ongoing impact of stringent monetary policies and increasing yields. In the United States, various factors including still tight monetary policy and the reduction of fiscal support are expected to decelerate economic growth to below the usual trend in 2024, although far from worrying levels absent a recession. In China, we expect a continued gradual recovery in the first half of 2024, followed by a return to normal growth rates in the latter half of the year. Low inflation is likely to persist on the mainland, partly due to policy preferences favoring production over consumption. Market implications and asset allocation. From our perspective, the current macroeconomic indicators for equities and other high-risk assets appear more concerning compared to last year. Current valuations are high, with volatility at low levels historically. Geopolitical and political uncertainties also add to the risks. Consequently, while the market sentiment is turning bullish, we are adopting a more cautious approach, especially for the second half of the year. Historically, stocks have peaked about 6 months prior to the beginning of a recession. If the anticipated recession begins towards the end of 2024, then we might see a few more months of positive market returns before a potential downturn. The extent of a decline in U.S. equities during the next recession is uncertain. High valuations and decreasing profit margins could exacerbate any downturn. This chart reflects our current projections of two key market indicators in the United States under two equally probable scenarios under our framework: a mild recession and a soft landing. Obviously, as the year progresses and we observe more economic data, the probability of one scenario should rise at the expense of the other. With a soft landing, the S&P 500's fair value lies in the range of 4,900 to 5,100, while the U.S. 10-year Treasury's fair value should settle between 3.6 and 3.9%. Under a mild recession, we would expect the index to trade between 3,500 and 3,700, while the long bond should trade between 285 and 315. Large caps and growth stocks typically perform better during economic downturns, so a defensive style strategy seems prudent. Lastly, U.S. equities generally outperform international counterparts during recessions. However, due to the high current valuations and potential constraints on the U.S. dollar's strength, this outperformance may be less pronounced in the next recession. Long-term, U.S. stocks have outperformed due to superior earnings and sales growth, a trend that needs to change for non-U.S. stocks to take the lead. We will address this issue in further detail later. Overall, our framework suggests that one of the better trades for 2024 remains to buy longer-dated U.S. Treasuries on a tactical basis. The long-term path for bond yields is influenced by several factors. Factors pointing to higher rates, including the end of household deleveraging in the U.S., increased capital spending, and demographic shifts like baby boomers spending their accumulated wealth. To the downside, potential deflationary pressures come from China's economic downturn and the proliferation of AI. Those could be the main drivers. It follows that current bond yields in the developed world seem more or less aligned with their fair value models. This means that investors could at worst count on the carry trade. That being said, we must be wary of longer-term structural shifts in real equilibrium interest rates. As this chart shows, they are poised to drift higher from here based on econometric projections. This means that once we pass this recessionary, i.e. deflationary period tactically, the longer-term structural bear market in rates that began in 2020 and asserted itself sharply in 2022 should reassert itself once again. In the future, we will advise you when the opportunity to short duration once again presents itself. Currently, U.S. high-yield corporate spreads do not fully reflect the likelihood of a recession, with default rates potentially rising. Therefore, we would encourage investors to favor investment-grade spreads within a fixed income portfolio in this environment. The U.S. dollar's trajectory has largely followed interest rate differentials. However, recent developments, including peak U.S. inflation, Europe's energy crisis resilience, and China's reopening, have influenced the greenback's strength. We expect the dollar to strengthen again once the global recession sets in, although not as significantly as during the global financial crisis due to different current conditions. Within the commodity complex, the oil market dynamics have shifted, with U.S. production at record highs potentially affecting OPEC's pricing control. But we nevertheless find crude oil currently undervalued. With respect to industrial metals, copper prices are likely to rise due to supply constraints. Over the longer term, industrial metals should broadly benefit due to the transition to electric vehicles and renewable energy, low inventories, and political uncertainties impacting mining investments. Finally, gold prices have remained resilient despite rising yields, possibly due to increased central bank purchases. While gold is expensive and above average production costs, its value is supported by central bank buying trends. Thus, we remain structurally bullish on gold, as we also favor it for its role as a hedge to geopolitical risk, which is on a long-term upward trajectory. U.S. exceptionalism. Will it last? U.S. assets have had an incredible and historic decade-long run. Since 2013, the S&P 500 has returned an annualized 13%, versus 12% for the Japanese Topix, 8% for the Euro Stoxx 600, and just 6% for the MSCI Asia ex-Japan. Despite much alarmism, the US dollar retains its imperial privilege as the undisputed global reserve currency, comprising 60% of global reserves, involved in nearly 90% of all global currency transactions, and 50% of all global trade invoicing, according to the Bank of International Settlements. Meanwhile, US GDP growth continues to outpace other developed markets. So, can the US sustain its pace of financial and economic dominance over the next decade? One factor in assessing this question is projecting the country's ability to continue innovating. American equity outperformance was driven at least partly by advancements in generative artificial intelligence and other technologies, boosting US productivity and growth. As this next chart shows, the US has increased its capacity to innovate over the last 10 years, climbing from number 5 in the world to number 2 today, trailing only the small nation of Switzerland. If it maintains this position, it is a good bet that it will continue to do so. One proxy for this trend could be the adoption of AI technologies. Here too, the US has no global peer. This map shows that the United States deploys the greatest number of significant machine learning systems globally. Canada, the United Kingdom, and China are all collectively a tier below. This means that US companies and institutions should continue to learn better and faster, leading to sustained innovation gaps with other nations. The ban on the most advanced semiconductor chips and equipment to China should maintain or reinforce that current gap. In fact, no other economy's growth prospects in the world should benefit as much as the US, given the potential boost from AI and favorable demographics compared to other major economies. Of course, we must not get carried away, as there are also some concerns. While AI adoption may favor the country, geopolitical shifts and demographic pressures could impact US equity returns, particularly if there is a reduction in company management's focus on shareholder value or increased regulatory and tax policy. In addition, the US's fiscal situation remains worrisome, particularly with the primary deficit. There are current valuation challenges, as the US indices are expensive relative to their global peers. Moreover, the heavy reliance on a few large companies and competition from other asset classes in the high-rate environment might hinder future outperformance. There are other regional competitors, as emerging markets are expected to grow faster. In sum, it is likely, though by no means certain, that US financial asset returns should remain at the vanguard of global portfolios for some time to come. Past performance is not a guarantee of future results. Or is it? Over the course of this report, we made the case that while the seas are tranquil now, storms may be looming over the horizon. Our thesis is that a global recession is more likely by the end of 2024, just when most investors may have concluded that a soft landing has been achieved, than the current market consensus suggests. This urges some caution, because while risk assets may grind higher for the next few months, they could face some headwinds as we end the year. Our framework is grounded on the notion that macroeconomic fundamentals trump all other considerations when making portfolio decisions. But what if history tells us otherwise? By now, we all know that over the past 20 months, markets experienced the most aggressive rate hiking cycle of the last 40 years. From March 2022 to July 2023, the Fed funds rate rose from a mere 0.25% to a high of 5.50. Given this history, we must ask ourselves what happened in the past when the Fed stopped raising and started cutting rates. While the macroeconomic outlook remains murky, and ultimately growth may dictate the path for markets, this same history gives investors reasons to be optimistic. If we look over the last 40 years of market data, both equity and fixed income have generally performed well after the Fed stopped its monetary policy tightening cycles and started loosening rates. On average, both asset classes have posted positive returns over the next 6, 12, and 24 months after the last hike and after the first rate cut. Of course, each cycle is different and has its own idiosyncrasies, but the aggregates nonetheless allow us to get an idea of what we might reasonably expect next. Looking at these Fed cycles over the past 40 years, both equities and fixed income performed better after the last rate hike than after the first rate cut. On average, fixed income performed better than equities during the initial 6 months and 12 months after a rate movement, with equities outperforming eventually. In addition, the U.S. 10-year Treasury outperformed nearly every fixed income index regardless of the nature of the Fed cycle. Even if we remove Volcker's period, where Treasury saw a 24-month period return of 69%, 10-year notes still outperformed every other index, posting an average return of 14%. Contrary to this, high-yield bonds underperformed the rest of the group in almost every period after a Fed policy pivot. Although, in theory, high-yield bonds are the securities with the most room for recovery once rate cuts begin, in practice, these investments need the right environment to outperform. To this point, high-yield beat other fixed income indices during the 1995 cycle, amid economic growth and controlled rate hikes. In other words, if rate movements are implemented for the wrong reasons, companies with weak credit fundamentals tend to underperform. On the other hand, equities performed better after the last rate hike than after the first rate cut, a dynamic which can be mostly explained by momentum, as rate cuts have traditionally come in response to a market dislocation or a recession. The S&P 500 has returned an average of 15.8% in both types of monetary policy cycles, outperforming the Nasdaq, which has reported negative performance over the 6 months after the first rate cut. In general, fixed income returns have been more consistent than equity returns around these inflection points over the last 40 years. Their outperformance is even more remarkable when we consider that we have used total return variables for this analysis, considering the fact that this metric includes coupon and dividend payments. As we mentioned at the onset of this piece, history has given investors reasons to be optimistic. While cash has worked well and as a safe haven over the past 12 months, it is important to keep in mind that both fixed income and equities have outperformed cash alternatives over the last 40 years of monetary policy cycles. While it is imperfect to compare today's economic situation to the periods previously described, history has shown us that we do not necessarily need to be bullish on the economy in order to expect positive returns. Staying invested for the long term is the key to investment success. Insigneo Financial Group, LLC, comprises a number of operating businesses engaged in the offering of brokerage and advisory products and services in various jurisdictions, principally in Latin America. Brokerage products and services are offered through Insigneo International Financial Services, LLC, headquartered in Puerto Rico, and through Insigneo Securities, LLC, headquartered in Miami. Both are members of the Financial Industry Regulatory Authority, FINRA, and Securities Investors Protection Corporation, SIPC. Investment advisory products and services are offered through Insigneo Advisory Services, LLC, an investment advisor registered with the Securities and Exchange Commission. In Uruguay, advisory services are offered through Insigneo International Asesores de Inversión Uruguay, SA, Insigneo Asesores de Inversión Latam, SRL, and Insigneo Asesores de Inversión de Uruguay, SRL, in Argentina, and through Insigneo Argentina, SAU, and in Chile through Insigneo Asesorías Financieras, SPA. Collectively, these 8 operating businesses make up the Insigneo Financial Group. To learn more about the broker-dealers, including their conflicts of interest and compensation practices, please go to https://insigneo.com/disclosures/ or via www.finra.org. To learn about Insigneo Advisory Services and any conflicts related to its advisory services, please see its Form ADV and brochure, which can be found at Investment Advisor Public Disclosures website, https://advisorinfo.sec.gov/.